I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens. Release your underwriters to underwrite with the Sapiens Advantage Go underwriting workbench. In insurance, we usually spend a lot more time talking about innovation than we end up doing it. So this podcast focuses on two of the doers putting innovation into practice. It's now 10 years since Hiscox launched its market-first, tech-enabled, live quote and bind FloodPlus product. And this episode examines the story of that product's development and its growth into a market opportunity that was primed for expansion. To guide me through the story, I'm joined by James Brady, Property Divisional Director at Hiscox London Market, and Tom King, the firm's Flood Line Underwriter. This is a story about overcoming obstacles, recovering from setbacks, and constant iteration. 10 years on, and Hiscox is the biggest flood market in Lloyd's, and the opportunity to write flood from the private market is only growing. Indeed, since we completed this recording, the Trump administration's council to assess the Federal Emergency Management Agency, which runs the National Flood Insurance Programme, has just issued its final report, recommending the implementation of risk-based pricing and a take-out programme to incentivise the transfer of policies to the private market. A link to the report will be in the podcast notes. With US market penetration still at only 4%, the prize for the private market is as big as any other underwriting opportunity out there today. Tom and James are sparkling guests, and this podcast is an inspiring celebration of innovation in action that has applications way beyond the highly specific field of US flood. Enjoy the podcast.
James and Tom, welcome to the Voice of Insurance.
Thank you very much. Delighted to be here. Great to be here with you, Mark.
For anyone who's listening out there who doesn't know either of you, why don't you just briefly introduce yourselves and run us through your career to date? Or maybe start with the thing that everyone asks each other when they meet and they don't know each other in insurance. So you say you're at a conference or something, you ask people how they got into insurance. I mean, it's maybe a good place to start. James.
I've been at Hiscox 19 years, almost to the day.
Are you a sort of Hiscox man and boy?
Yeah, I think that's the way they would put it ultimately. But yeah, started age 22 in Glasgow, nearly 19 years ago. And that, how did you get in insurance? I think it's quite sad the way I think most people answer this. So like many, I fell into insurance, didn't plan a career in insurance, but have been really, really fortunate and lucky to have found Hiscox and insurance in the great industry that we are. And I think the purpose that we have in global society in terms of keeping everything going and the world going round.
You saw the Fleur de Lis logo and you thought, right, I want to work there.
No, I had no real idea who Hiscox were and what we did. But it's funny, whenever you go through an interview process, I think you get a feel for what a company is going to be like. And I just got a really good feel and vibe from the interview process and the people I was exposed to from a Hiscox standpoint, and thought, I'm going to give this a shot. If I don't like it, I can always find something else. And I guess here I am 19 years later, having had a great time.
I think it's always nice in an interview when the company is actually humble enough to remember to sell you the idea that you should probably want to work there. You know, obviously we know that you want the job because you've applied for it, but at the same time, a lot of companies forget that, and I think it's a bit of a failing on their part. But I suppose Hiscox is a different type of company. I probably made the effort to attract you to them as well, you know, and make them think, well, if we want these people, we better be nice to them.
Absolutely. And actually, on reflection, was quite surprised about the seniority of people that I engaged with, even at an entry-level underwriting role for Hiscox, that probably did make them stand out. And then actually, not to go off topic too much, but within the first 3 months, Bronick, former CEO, happened to be in the Glasgow office and actually took the time to put 15 minutes in with every single person in the office to have a chat, to introduce himself and answer any questions. And I think that is a genuine differentiator for who Hiscox is and what our story is as well. So it was great to get that time.
Be nice to be able to say, well, when he does become a Lord Mayor of London, I'm not sure exactly, but it's kind of, he will become one of the Lord Mayors in the next couple of years. So it'd be nice to know that you'd be able to say to your mates, you know, I actually know the Lord Mayor of London.
Wow.
I know the current one, Lady Mayor, which is good because insurance is doing pretty well at the moment. And then what sort of roles did you run through and how did you end up doing what you're doing now?
So I'm fortunate enough to have had a pretty varied career at Hiscox. I alluded to starting in our Glasgow office. And I spent the first decade and a little bit more in Hiscox UK, in the retail arm, in the great business that is, doing lots of different things. So high value household to begin with, then into commercial, then specialised in media and cyber. And then about 8 years ago, made the move into Hiscox London Market and the brilliant business that we are. Always fancied working in Lloyd's. In the media sphere, had a bit of an opportunity to write some syndicate-style business and lead some global placements for some of the biggest names in the media world, and that whet the appetite. And I thought, if I don't try this at some stage, I'll always probably look back and regret it. So made that move, done a number of different things in London market. So worked in cyber, I led our alternative risk portfolio, I ran a marine and energy division for a short period, and I took on property about 3.5 years ago. And in property, we run major property, which is traditional D&F, which we've had a long-standing play in. We've got a new and emerging and growing entry into middle market property, so that's slightly lower TIVs in the D&F world, so 50 million to $1 billion, where historically we've always traded the $1 billion plus. Technology and the advancements in that now enabling us to trade that a bit more efficiently, which is a really exciting growth potential for us as we look forward. We've got a really prominent play in property binders, traditional binding authorities in Lloyd's. That's commercial lines, earthquake, but equally a really big play in high value homes, something that we've been in as a business for a long time as well, so 50 plus years. We've got a digital play in that, in Bind Plus. And then lastly, flood, which we're here to talk about today, ultimately. So celebrating 10 years of our FloodPlus platform, something that we're really proud of and a really big part of what we do.
And just for anybody, DNF obviously is direct and facultative. That means mostly facultative, meaning facultative reinsurance of very, very big global property programs, as it tends to be, because it could be DNF of anything, but it really means property, doesn't it? I mean, really big property that's too big for any one insurance company to take hold of. So it's kind of shared and layered and brokered, and everybody's writing it to a greater or lesser extent. And what was the other one? TIV, total insured values, i.e. the schedule of values, what you're actually insuring, all those buildings. And Tom, your turn.
I guess I had a slightly more conventional route into Hiscox. I was actually working up in the city for a shipping management company. They had a joint venture with a broker. So quite early on in that role, my first role after university, I had the opportunity of going into Lloyd's. And whereas James didn't see the fleur-de-lis, I saw the fleur-de-lis on the ground floor of Lloyd's there. And actually, when I decided after a couple of years in that role that I wanted to pivot into more insurance focus, Hiscox was one of those standout companies. Having seen them front and center at Lloyd's, all the exciting things they were doing, I actually applied for the graduate scheme here. Joined in 2015, 10.5 years ago, which leads on nicely to how long we've been doing flood. I've been involved in that journey from the very beginning, but started in personal lines on our delegated authority book, which gave me, I guess, more of a day-to-day grounding of what it's like to underwrite business. Lots of time sat in Lloyd's, getting to know the brokers and starting to see more of the portfolio side. And as flood started to emerge as a opportunity that Hiscox wanted to go into, I was hooked in by the scale of the problem, the underinsurance for one of the most widespread natural disasters. Having done a geography degree as well, it was something close to my heart. And some of those GIS and shapefile modules I'd done at university and I thought I'd never use in my life ever again suddenly started becoming useful, which was a pleasant surprise.
The obscure module in topography suddenly had some application.
And at that time, I was the keen grad trying to say, oh, I've used that GIS module before when we were starting to scope out how do we model flood. Can I give you a hand? And I think everyone was like, I can take some work off my plate and he'll do it for me. So
So you kind of taught yourself into this FloodPlus role.
Yeah, it was a great opportunity for me as a new entrant into the business where working in the personal lines, the binder space, the wind, fire books, they're very well developed. Hiscox had been doing them for tens of years. But flood was this new emerging area of the market. There'd been changing regulation in the US and it was a chance to do something different and really make a mark. We always used to say no idea was a bad idea. Either we thought of an idea, we did it and it was a good idea, or we thought about it and went, okay, we're not going to do that for various reasons. We'll pivot to something else. So it was an opportunity to make a mark and be involved in something new early on in my career. So was part of the development of FloodPlus right from the very beginning. Hiscox are very good at helping to broaden insurance education. So I've spent time in the US with one of our cover holder partners, time with our claim team on secondment in general liability. I moved away to run our alternative risk team 3 or 4 years ago, which gave me a different lens, which then moving back to run flood 2.5 years ago as our line underwriter really gave me a broadened aspect, and that's where we are today.
I mean, we're here partly because FloodPlus has come out for 10 years. I remember it was launched. I've been around long enough, reminded of my age, 10 years is nothing. But how did it all come about? Whose idea was it? Can either of you take any credit for it, or how did it all come about? What was that opportunity that you saw?
I think there'll be lots of people who we'll try and...
Everyone wants to claim these good ideas. Yeah, the ones that work.
Yeah, I'll go through it. It was a combination idea of our personal lines team at the time that we insured wind, fire, earthquake, and with the opportunity in the biggest water act in the US market opening up to flood, we thought, why can't we do that? We're always challenging to do things better, and there's an environment here for innovation. And flood was really something where we thought, look, we can do that better. We've got good distribution through our cover holder network. If we can then create a desirable product, and look, the NFIP is great. It's been around for a lot of years, but there's systematic flaws with it in terms of reduced limits, restrictive coverage. We said, look, if we can create a product that agents want to sell, insurers want to buy, and will ultimately pay at claims time, and then price that sustainably, price it in a more intelligent way using models with digital distribution, that was the challenge we took on. And really just went from there. We started initially selling it as a cross-sell product on our homeowners book, but it quickly became apparent that it was a wider opportunity as a standalone flood product. Since then, we've expanded with residential, commercial, excess, variable attachment limits. And really the idea is that flood risk is everywhere in the US. FEMA have reported that 99% of US counties have experienced flooding in the last 20 years, yet only 4% of homeowners carry flood insurance. Obviously then commercial as well being a similar number. That gap is staggering. So it's just how we can take a long-term mindset to create a product that we can distribute and scale in that environment and help to close that insurance gap.
I think I'd just add there, though, in terms of the idea of flood, just to sort of emphasise the point that it's in the Hiscox DNA to embrace risk. And I think in this instance, 10 plus years ago, the not so well understood peril of flood, which could be pretty severe, and maybe had been in some instances, to really challenge ourselves to get our head around that and deliver a solution that helps unlock the progress for customers, but equally the marketplace that we trade in, and just gives us the opportunity. What we've done is deliver a technology solution to that, but I think also nicely with people at its core. This is a people business, and we can scale with the technology, but we've got the experts and the relationships to distribute at the core.
Of course, this was founded around the beginning of that insurtech boom. Would you call yourselves an insurtech? Is it a tech business, particularly? Tech first?
Look, it's definitely a technology-led platform that enables us to distribute the product. This is a high-volume, low-priced marketplace that you need an effective and efficient technology offering in order to have a seat at the table. And we have that. To give you a feel for that, we've got 4 underwriters and 1 pricing head here in London, and we trade nearly 100,000 quotes digitally a week. I still find those numbers absolutely staggering. You just could not possibly do that.
You're not answering the phone and giving them a price, are
No.
you?
No, sitting in the box in Lloyd's trying to quote each individual one.
You can't scribble paper that fast. And presumably the results have been pretty good.
Results-wise, over the last 10 years, I think it's fair to say that we've been tested. If you think back to events, we have had hurricanes, Harvey, which is year 1. So really testing
us. And there was
us.
a lot of water in Harvey, wasn't it? I mean, it was most of Houston, wasn't it?
Yeah, absolutely. We've got Ian.
Houston's not particularly well designed for flood, is it?
No.
It's almost designed to flood.
It's a lot better designed now than it was 9 years ago in August 2017. When we talk about results, we always talk about Harvey. It was year 1 on the book. And when you're scaling a flood book...
That's almost like the law of underwriting, isn't it? That the really bad loss happens in year 1.
Yeah, absolutely.
So Sod's law,
Yeah.
Murphy's law of underwriting, yeah.
And we had a concentrated book in Texas at that time. We had a large loss versus our portfolio size. But in true Hiscox fashion, there was belief in the plan. There was belief in what we were doing. And actually, it was an opportunity initially to regroup and look at that forward-looking strategy. But actually then going, right, this is space that we know, understand, the book's been tested, there's lessons learned. We can now grow into this. And it was the catalyst for growing FloodPlus and the platform.
And I suppose the product is ultimately the claims handling and the fact that with NFIP, you can't get very good limits on the contents. Presumably, people could say, well, I have this new FloodPlus thing, and it's great because all my neighbours are getting, even if they did get the NFIP extensions, they're still, pardon the pun, I mean, they're more underwater than I am.
I think that is the proof in the pudding of an insurance product is that when the loss comes, it's going to pay. Our idea initially, like I said, was to have a broader product with wider coverages, ancillary coverages that you might not have been able to get under the NFIP, things like loss of use, and of course that full indemnity. Once you go past on a residential home, a loss of 250,000, that is all you'll be collecting with the NFIP. quite often that's not enough to fully rebuild. So,
And was it also service? Because again, being a journalist, when I look at the NFIP, I just look at this sort of huge outstanding number that never seems to come down. One would presume that it's not that quick to get that claim paid, but if it's a commercial insurance product, you'd hope that you can give better service so they can have that claim settled much more quickly and be back on their feet quicker.
yeah, absolutely. We've got a great network of MGAs cover holders who are not only distributing FloodPlus, but then TPAs, DCAs who are very familiar with our flood product. Actually, the feedback was it's easier to adjust than an NFIP product because the coverage is clearer, there's better definition of flood. So for them to be able to go in and quickly service, pay a claim and get those closed quickly and indemnify the insured, I think was and remains a key sell point of FloodPlus.
But there's a big education piece to be done as well. I think, unfortunately, word of mouth doesn't really cut it in terms of the scale of not just the problem, but also the opportunity, I think, in the US, where you've got 80 to 90 million single-family homes, but only 6 to 7 million actual customers who buy flood insurance. So therein lies both the problem and the opportunity, I think.
You've already kind of mentioned about the distribution, but specifically, it's what we would expect. I mean, all the brokers, all your cover holders, is there anything special about the way you distribute it? And again, we've got a digital platform.
Yeah, so it's through MGA's cover holders in the US, supported by London brokers as well. But what it is our fully digitally driven API. So we're able to essentially hold the pricing black box, which then APIs into our cover holders' IT distribution systems, which they can push down to agents. So the idea is it's just fully digitally embedded through quote, binding, cancel, renew, reinstate, endorse, the full policy lifecycle. So we then get real-time view of quote data, bind data, exposure data, and our cover holders are able to distribute it with as little resistance as possible. So the digital is key to the way we scale the number of quotes we do, but that is complemented by the underwriting side here in London, but also our MGAs. We see them face-to-face in the US and when they come over to the UK, and I don't think you can really replace that human element either. I think a great example of that, and it goes back to a claims time, was one of our cover holder partners after Hurricane Ian wanted to get boots on the ground on Sanibel Island. All access was restricted. He wanted to go and assess the damage, speak to some of their insureds, and just get the claims process moving and an idea of what had happened. So this guy went and bought a boat, small boat, and put on his captain's hat and sailed over to Sanibel Island just to go and do that. And we talk so much about all the things that digital and APIs unlocking. It might happen in 2100, but I'd like to see AI go and get a boat and sail over and reassure the customers.
So what is your underwriting philosophy? Is it about having just so much more granularity right down to the sort of last square foot of where you're underwriting, whereas one presumes if you're competing with things like the National Flood Insurance Programme, that they're likely to be less granular, one would presume, because they're going to be more broad brush. And is it about granularity and finding the good areas within what have been deemed to be bad flood areas, for example, and cherry picking those? Anyway, you tell me, because I'm just putting words in your mouth at the moment.
With the peril of flood, we're talking about a pretty binary natural catastrophe focus.
Some people live up hills, even if a couple of feet of elevation makes a big difference, doesn't it?
Yeah, absolutely. And that's what the platform and the data that we have available to us that augment that underwriting decision-making process as part of the FloodPlus platform really helps us take a view on every single location, and we can almost return a price on any location in the US as to our technical premium and what we would want to return the margin that we desire on any given risk. Whether that's competitive and or palatable might not always be the case in some of the very exposed areas, but I would say more often than not, we'll be pretty competitive both with NFIP and our private market peers. Overall underwriting philosophy, the way I look at it, is discipline, and with flood, it's about diversification in the exposure as we scale. We can manage it very, very granularly, down to individual location, a street, a zip code, a county, 5 kilometre, 10 kilometre, 60 kilometre, 300 kilometre radials to manage exposure and sort of a blast zone type basis to ensure that we are not overly exposed in any given area. But as you grow the overall pie, your overall tolerance in those individual locations can grow ultimately with that. And I think from a people standpoint, it's down to Tom, who leads the line and product, and his team to ultimately manage all of those variables at the portfolio level to deliver the growth and realise the opportunity in flood, but equally deliver the returns that we ultimately want at that macro and portfolio level.
Presumably now you've got to a level of maturity where you've got that nice diversification. It's not all Mississippi, you know, or
No, not at all. Florida is complemented by California. We've got stats. 2/3 of our portfolio is more than 10 miles or more from the coast or in an inland state. So that coastal exposure really nicely balanced with non-coastal and or inland exposure.
sometimes you look at things and between the Appalachians and the Rockies, it is just the Mississippi, isn't it? Pretty much. Does everything end up in the Mississippi and end up down in New Orleans? So I was just thinking, isn't that all the same thing? Because if it floods upstream somewhere near Canada, it's still going to end up down in Louisiana, isn't it?
That was the one thing James missed
It's
when
4
we said...
months later, so you've got time to save up.
Yeah, so it's what James missed when he said all the granularity we're looking at. The most granular, I guess, is those drainage bases, and the Mississippi is...
It's the main event, isn't it?
Yeah, and it helps that we can look in real time what we're quoting, what we're binding, looking at those aggregate levels and putting those controls in place to allow that spread. It's the same with a hurricane or a nor'easter event. These will happen, and that's why people are buying the insurance. So having those controls in place and knowing that we're accurately priced on each individual risk. So on the portfolio, every risk we write needs to be sustainably priced at an individual risk level. The digital system allows us to do that. We can look at the ground, various flood depths, surge, surrounding topography, pluvial, fluvial, rainfall, how that's going to impact it. And if the price is right on that, we are comfortable writing that risk. So the way then we scale, and we can do that, whether it's the way we price or our distribution partners and where their marketing efforts are, allows us to keep in mind that those events, those are the downside.
And there is reinsurance, though, one presumes, as well, available.
Absolutely.
Who do you see as your competitors? Do you see yourself as competing with the NFIP? And if you do, is there an inherent instability in that because you're competing with something that's not necessarily a commercial rival and it's state-backed, and so therefore sometimes it's difficult to compete with something that might see itself more as a subsidy for housing costs in general at a high political level? Is it sometimes difficult or impossible or foolhardy to try and compete with it?
There's a role to play for everyone who's currently in the flood market, be it NFIP or private, and we talk about the addressable market being enormous and the proportion of customers who currently buy being pretty small. So the opportunities are pretty acute. Flood is a peril that will affect the majority, if not all, risks in the US. Hence, there's a real role to play. The NFIP has some well-documented challenges in terms of the annual deficit that it runs at, the interest cost that it runs at on its cumulative deficit that's running into the 20 billions now. I think 22, 23 billion is where it currently sits at. There needs to be some sort of reform. Federally, they are looking at that. We, as a key part of the private market, have a seat at the table for those discussions in terms of what that looks like. But there's a huge education piece as well in terms of educating customers about flood and about the availability of flood, both either federally and or privately. But with our 10-year journey already, the longevity that we have in the marketplace, the experience that we have, not just selling policies, but also paying the claims that we've just talked about, that really sets us in a real strong position to lead the growth in private as we move forward into the next stage of our journey.
The market is huge, but us in the NFIP and other private markets, we have different views of risk. The way we look at it is similar, but different. And that's the reason why we're pricing differently to the NFIP and we're writing risks where we may be cheaper. The other thing is we aren't necessarily always in direct competition. We can complement the NFIP as well. If an insured can collect an NFIP policy at a certain price and then buy a Hiscox FloodPlus policy as an excess to buy them up to full indemnity or some of those other covers, then I think we can all grow and we can coexist.
You're happy to wrap and then go on top.
Yeah,
of
setting
NFIP.
excess and buying up to full replacement limits, which we're seeing a huge amount more demand for, just as that static 250 or 500 on the commercial becomes worth less over time as replacement costs increases.
And what's the market like at the moment? Obviously, we know anecdotally elsewhere in property lines getting much more competitive. What's it like in flood? I presume you have a different cycle from everybody else. So it's just a different circumstance. But tell me what it's like out there. Is it more competitive than it has been?
I think the level of competition is increasing. However, you're exactly right in terms of the cycle. And with the largest competitor that we have being the NFIP, it's a slightly different dynamic in terms of how they manage the overall. They have caps and traps and they cap the increases at 18% annually. Hence, that's the limit that flood has. But where we're seeing big reductions in wind, quake, and those peak peril exposures, we do see some buoyancy still in the flood market going forward. I think if we look at adequacy levels, probably does require it as we move forward. But our focus as well is on the opportunities at hand. And, we've recently had some initiatives where we've focused in on the X-zone opportunity. So those are the lowest hazard customers as we see it in the US, and really bringing a product to market at a price point that really makes flood accessible to those customers and puts it really in scope for them to tailor it with their household policy, and then distributing it through our partners that can then sell it alongside household, really trying to fill the protection gap for those customers.
Obvious question hadn't occurred to me is, how nimble can you be on rate filings and things? Is this distributed on an admitted basis or a non-admitted basis?
We're non-admitted. So
it's non-admitted, so you have freedom of rate change. You don't have to ask an insurance commission's permission to put the price up. Right.
Which also means you can focus a lot more on models, the way those updating, changing as peril of flood changes and new information, which I think is the power of being able to offer a long-term flood product.
The land doesn't say the same. It's always changing. People are concreting over different things, or, good mitigation is being put in different places. And so it's changing all the time. Every time the satellite flies over, it sees a different thing.
Also where people are living. Imagine a nice house in the US. It's probably the image in your head is near by the water, by a lake, by the sea. These are the desirable places to live. People want lake houses. They want to live in coastal Jersey Shore, New York, the Carolinas, Florida, on the waterways. People are moving there. There's more development. And these are areas that either traditionally didn't have buildings on or have higher value buildings being built on them. And that's something, a change in dynamic that we need to stay up to date with flood. Overlay that with changing peril. I think last year, they haven't released the full year stats, but midway 2025 was trending towards having the most flood flash warnings in the US ever. So clearly there's flood risk is broadening, becoming more volatile. It's up to us to stay up to date with that, stay up to date with where people are moving in, come up with a product that embraces that risk, but is also sustainable.
Is it more competitive than it was? I can't remember if we settled that or not, the market at the moment. And obviously there are other private flood schemes available, underwriters. I presume the market is more crowded than when you first entered 10 years ago.
Yeah, there's definitely more entrants in the market. Is it more competitive than what it was? I think that is fair to say yes at certain risk levels, but then I think where it is priced relative to the exposure, where it needs to be as well.
And you've got a head start if you have a bigger book and more diversified book. You have the ability to be more competitive where you want to be.
And with the volume of distribution that we have as well, you can see where you're winning, but equally where you're not winning, and try and laser your focus on the areas that you want to grow that help with the diversification.
I think first mover advantage is key. Hiscox, in a way, took a risk at entering the flood space early. That's the DNA. But what it's meant is we did get that head start. But it's not about then resting on our laurels. It's about continuing to innovate, update the products, update our view of risk. And like we've done with our X-zone products, where we've reduced our minimum premium down to attract those lower hazard customers. We've increased our limits to attract higher value customers as well. So it's broadening and expanding and continuing to just stay at the very cutting edge of the market.
I suppose with Hiscox, you've always had a good association with higher net worth property. For example, you've always had a good into that market. So again, to presume this correlates quite well.
Yeah, absolutely. It's part of the Hiscox DNA again. And there are expertise across the group that we lean on, whether it's high value team for their view on how that might perform in a downside of an event versus a regular value firm. Also our Hiscox retail business, we're experts at dealing with high volume customers, more of a digitized market space that we necessarily didn't have in London market 10 years ago. Mm-hmm. Bringing in people from other areas of the business for those expertise that we have. Our IT delivery team is just something that we've really been able to take advantage of.
Where are you getting the most opportunities geographically, obviously within the US? Were you putting on the most business and finding that, you're really winning?
So I think, look, when you think of flood, you think, I said, Florida, Texas, Louisiana, New York, but really we are open everywhere. We write in every single mainland state. We've got risks in the Rockies. We've got risks on the Florida Keys. We are open for business as long as we're using our data to best price those risks. We are keen on diversifying away from those very heavy coastal areas as well. And it's not only getting those who are currently purchasing flood, it's linked to their mortgage to change their product and either pivot to the private market, but it's just using data, risk definition and affordability to unlock new demand and expand the customer base.
You must have both learned huge amounts about flood, probably more than you would ever imagine you would ever do in your life, and obviously even with the geography degree. When you're underwriting, when you're tweaking your models and pricing models, what things are you able to give the most credit for? What mitigations actually work the best? I'm just thinking of something practical for anyone listening. Obviously, some of these might be at almost state level, some of them at local authority level, and some, of course, at individual house level to say, how could I make my house a better risk than the one next door, other than put it on stilts?
Starting at the wide level, at government schemes, there's been a lot of money spent in New Jersey, New York, in New Orleans on just flood defences and investments in making cities and localities resilient to flooding. So I think that's something we're always looking for, trying to stay up to date with, whether that's man-made or natural defences, and making sure we're really taking that into account. On a more building level, we love a risk that has mitigation that's going to impact the performance
if I've
and
got a really
proactive.
big pond, it's better, isn't it? If I've got a really deep pond in my back garden, it does a lot of the water go
as long
down
as it
there.
doesn't start overflowing. But look, I think for us, that elevation is massively important. I think where the building is built up above the ground, there's various numbers used, but roughly it's around $30,000 of damage for every inch of water that goes into the home.
So you can get pretty granular down to those. You're looking at those inches.
We'll be looking specifically at the ground, where the living floor, or how far above the ground the living floor is, and crediting based on that in the event. So taking into account things like foundation.
It's if I move the living room upstairs and all the TV and the sofa and all those things that always go. Whenever I see them on the news, there's always the TV and the sofa sort of under looking brown water, looking very nice. Does that best mitigation, most simple thing?
Well, I think that does help, right, in the event, moving the valuables up. But also look, things like sandbagging. When a hurricane's coming, the US are very good at putting warnings in place. Often people aren't able to do that, whether it's availability of materials or even not being in the area at the time. But things like sandbagging, any other kind of proactive flood defences that will stop that, and just being reactive to it, reporting the claim quickly. All of these things help to reduce cost and damage and make sure someone's back in living as quickly as possible.
And at those more local authority levels, I mean, presumably you can feed those in where they're sort of, creating a new wetland, and that's good. One, it's going to be good for wildlife, but two, it's going to catch a load of water or slow it down. Those things, do they work?
Yeah, so we spend a lot of time looking at thought leadership, research studies on things, whether it's like mangroves and especially how those change after a hurricane event. But then also just getting as close to it as we can. So later this year, we're going down to Louisiana. We've been invited by the insurance commissioner to have a tour of their flood defences. So again, getting as close to that as possible, understanding it, and ultimately...
So you've got waders in the back of the car, always.
Might be we'll have to borrow the cover holder's boat.
Well, yeah, and watch out for the gators, obviously, while you're down there, Obviously, the US is a huge market. It's half of all the premiums in the world. Most of the time, when I'm looking at maps of the insurance world, half of it is the US. But you've learned a huge amount about this. Are there any other markets in the world where you think you could expand geographically? Again, it would be pretty good for diversification, wouldn't it? I mean,
Yeah, it's a great question. I think you are exactly right. The opportunity in the US in terms of that addressable market is enormous, and where our efforts are focused right here, right now. I mean, that said, at Hiscox, we're always challenging ourselves to break new ground, do new things, tackle new areas. I would say that the level of data quality, sophistication, timeliness, confidence level that we have in the data that helps support our underwriting on the platform is high in the US. It would be less well known in potentially other areas. So that would be a consideration, but it's not out with the realms of possibility that we look at other areas longer term.
Because you've got transferable skills. Okay, the problem is obviously the politics, and just if flood's thrown in, there's a standard all risks.
That was another point I was going to make.
No one's going to need to buy it.
The US is relatively unique in how it deals with the peril of flood, in that it's excluded in most instances on residential and sublimited a lot in commercial policies. That almost creates the marketplace for it. But if it's given as standard as part of an all risk policy in other territory, that then provides challenges to creating a new market for it. But we're underwriters and we will look at every opportunity and territory, I guess, on its own merits as to what the opportunity looks like, what the scale potential could be, and how profitable do we think it could be as well.
So it's not as if you're working on something right now, but you would never say never. You've been very much a tech first type business. So I'm just imagining that AI has been a fantastic boon for you. You must be brimming, another water related metaphors, brimming with opportunity there to apply. There must be some really good applications for AI in your business, particularly where you've already gone semi-automated anyway. Anyway, what have they been and what have been the most successful applications you're able to find so far?
Hiscox have been doing some brilliant things in AI, and I think specifically in flood, we've had clear benefits delivered for things like pricing refinement, risk selection, and automating our underwriting workflows. So what AI has helped us do is remove friction and improve consistency of what we're doing.
So it's like when some new geographical data comes out, you're able to ingest that quicker, one presumes, and you can start repricing quicker. Say, wow, we've got this new survey and it's right down to the millimetre or whatever it is. And now, great, that is even more granular impact on our pricing.
Absolutely. And then if we then want to implement it into our pricing, that's still the human element. And we're assessing that, going, right, how's that going to impact what we're doing moving forward? So I think by doing that, it's just enabling us to see that information quicker and then feed it back into our underwriting process. I think in a longer term, it's something we're talking about almost every day, is how we can bring AI into more of a kind of real-time risk assessment, things like smarter claims triage, and just give more personalized pricing.
Certainly, I've had a lot of applications in claims. I'm flagging the ones to say, I think you need to jump on this quickly because this could be one of the ones that, if you leave it alone for too long, it's going to be the painful one.
Yeah, and considering that, I think I'd just add at a more property division syndicate level, using AI to do things like cleanse statement of values.
Just good old-fashioned block and tackle stuff, because the stuff we know is always wrong. If you study any TIV, there's bound to be one mistake in it somewhere, isn't there?
Absolutely. And something that would historically have taken 24, 48 hours, now taking minutes, which allows you to get to that submission, if you need to, much quicker. We're doing things like slip-to-slip comparison, last year's slip versus this year's slip, quoted slip versus slip that's been proposed to be bound. Then the progression of that is thinking about survey reports and the more complex engineered risks that, with the greatest will in the world, if you get 60 reports on the multiple locations on a heavily engineered risk, you'll never be able to get through them. You might pick some of the top locations, but what large language models can do is ingest them all, and actually ingest them all historically and see how a location has trended over time. Has it been positive? Has it been negative? Do you need to ask further questions? Do you want to apply some terms to it as well?
Well, that's fascinating. Isn't it? I remember when I was a broker, seeing this huge schedule of values and thinking, how on earth are we going to attack this? And then going out in the market and realizing people were only really interested in the probable maximum loss at the top location. And that's how we're structuring this whole thing. I was thinking, but there's 300 other buildings here, and each one of them is capable of blowing up about 10 years of premium. But we're not actually looking at those because we're thinking about it, but because we've found a way of approximating. Say, what's the most important thing to look at is this one top location. That's really going to be the problem. And fair enough, if you're on a massive excess layer, that kind of is the problem. That's the only thing that will reach there. But it was on the primary. It was, anything. It was any one of these 300 buildings could blow you up. But we only seem to be looking at one or two or three of them. And anything that can help with that work, that we'd all be better insurers and would be better brokers if that work were done. Then if the AI can do it, I suppose, fantastic.
Yeah, our view is it augments the underwriting process. It doesn't take away the need for the underwriter, but it provides the underwriter with more data and information in order to make the correct decision on pricing or acceptance of the risk, is what we're trying to do.
So you should be able to do more. Ultimately, you won't have to ask the boss. We can double in size without having to double in headcount.
Yeah, I think flood's a great case in point of that. The volume that we can trade with a relatively lean underwriting team is a great example of that. But it's pointed at the market opportunity. You're required to trade that scale in the flood market. In traditional DNF, as we talked about earlier, probably doesn't need that solution that overlaid to it in terms of trading the scale. But what you can help those underwriters with is prioritise the risks that we really want to underwrite, the ones that are right at the core of the appetite, get them to the top of the list in terms of what we're going to do today, and prioritise them with our key brokers that we're most likely to win the business with and create the portfolio that we want.
Yeah, I'm presuming there's always going to be human in the loop here because of claims. Ultimately, there's always going to be human in the loop. It sounds like you can automate almost everything about the underwriting process. Would that be right?
I think when it comes to flood risk, it is complex. Human judgment's always going to matter. I think when it comes to things like aggregation, capital deployment, portfolio strategy, the role of the underwriter is as important as ever. But automation is a good thing. The majority of FloodPlus is already automated, which frees up our time to concentrate on those tasks, with the system really then doing the heavy lifting.
And so you can just sort of press buttons and twiddle knobs and things, metaphorically speaking. And that's how you do your underwriting. It is sort of dialing up and dialing down.
As I said earlier, that's the job of Tom and the team to do that. There's also some other business outside of FloodPlus that we underwrite, some of the more shared and layered, larger limit type business that we see on a prior submit basis that we underwrite with the brokers here in London, that keeps your eye in terms of the overall marketplace, what's happening, the competitors in it, what's happening with product, all of that stuff that is really key to keeping you at the forefront of what we're doing.
I've really enjoyed talking to both of you. Is there anything we think we've missed? But I've come to the end of my questions.
Just to emphasise, we are immensely proud of the journey that we've been on with FloodPlus in the first 10 years, but lots of opportunity still ahead of us, and really excited and fired up about what the next 10 years can bring and the future thereafter.
That penetration rate being only 4%, I mean, there's a huge amount of open runway in front of you.
Absolutely.
So good luck with the next 10 years.
I think, yeah, happy birthday, FloodPlus. Happy 10th birthday. We'll see where we are at 20.
Thanks a lot.
Thanks, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.